It's a treat to have you on the heels of Brexit. Wondering, with the deal around the corner, how you feel that's changing your planning for Standard Chartered.
Okay, well, thank you very much, and it's really a pleasure to be with you today. What we have now is an agreement between the UK government and the European Union, which still needs to go through both the UK Parliament and the European Parliament. But I think that what's happened is encouraging, and certainly if this deal goes through, it would be, in my view, very, very much of an improvement over the alternative of a no-deal Brexit. In any case, for Standard Chartered, as you can imagine, given our footprint, where we tend to bank mainly in Asia, Africa, and the Middle East, although we have very important clients both in the United States and Europe, we are less affected by Brexit than other UK banks. But in any case, we put in place already with sufficient anticipation our contingency planning, and what we have done is to create a subsidiary in Frankfurt. Before we had a branch, now it's a subsidiary, and then the other European subsidiaries, the European branches that we have, will also be part of that subsidiary. So we will be able to provide continuity of service to our clients without any interruption. And already our Frankfurt bank has started to operate over the last few months and has been doing so in a very smooth manner. So for us, regardless of the final outcome of the process, we are already operating under the new regime and doing well.
Speaking of Frankfurt, you have negative interest rates right now in some parts of Europe and in Japan. Wondering how the negative interest rate environment, what are the longer-term ramifications of that?
Well, we have gone from speaking about low for long to lower for longer, and now some people are speaking about low forever. So I think that this is something which is quite remarkable, that 10 years after the global financial crisis, there is a need for monetary policy to have this degree of accommodation and to have interest rates in the negative territory and to have $17 trillion of public bonds in negative territory too. So I think that this is something which is quite remarkable. And I think that's a consequence of the fact that growth has been it's been subdued after the global financial crisis, and we're seeing the loss of momentum of the global economy in the last few quarters. And at the same time, that inflation has been stubbornly low, well below the targets and objectives of central banks. So that, I think, is what has prompted this interest rate policy. But let's not forget one thing, that these very low interest rates are also a reflection of the fact that there is too little investment and too much saving in the world. So when you have that combination, real interest rates drop, and then monetary policy in a way accommodates that movement. So the question is, what do we need to do in order to improve investment in the world? And that comes from structural reforms that improve productivity. It comes from policies that enhance trust, confidence, and therefore that we have the investment boost which is needed to improve growth in a sustained manner and to take us out of this very low interest rate trap in which we are. But it takes much more than monetary policy. Monetary policy is not enough to get us to a better world.
I'd like to ask you about Standard Chartered for a second here, given that so many banks around Europe right now are shrinking their footprint in light of all the global tensions and light of the larger macroeconomic outlook. You have HSBC shrinking inequities, cutting costs. Do you think that's the right strategy? Can we see Standard Chartered making similar cost-cutting moves, for example, or what is the bank supposed to look like in this environment?
Well, I think I will not comment on what all the peers are doing. I will just comment on what we're doing. And I think that keeping costs under control is very fundamental. And in our refresh strategy, which we announced in February, we are, we announced that we will do so, over time, and we have been doing so. And when we published our last results, we showed that was happening. So it is very important to make sure that you create what is called positive jaws between the growth of revenues being higher than the growth of costs. So I think that cost control is very important. But it's also very important to make sure that you grow revenues, and that you grow revenues in a strong safe and sustainable manner. And that requires appropriate risk management policies. It requires identifying the opportunities where they exist and going for them, and that's what we're doing. And digital is a big part of this. Digital innovation today is critical for banks to be able to put forward before their clients and customers propositions which are second to none, and I think that's very fundamental.
And do you think M&A is a requirement really for banks across Europe now in the current environment? What is your outlook for where Standard Chartered
I think that it all depends. If you look at the European environment, you have very large players, and you also have medium and small players, so they come in all sizes. And what you have is thousands of banks which are medium and small. And the question is whether Europe doesn't have too many banks, and how many of these banks really have a viable future in a context where liquidity wasn't given for free, as the European Central Bank is having. So what this means is that there is, in my view, a structural issue about the continental European banking sector that needs to be addressed, and that requires significant consolidation. And I think that a lot of attrition at the medium and small level as well.